Good morning, good afternoon, good evening, traders. Wherever you are in the world, I hope you're doing well. I hope you're safe. I hope you're healthy. I hope you've got a big smile on your face. And I hope you're catching pips as usual. Pips of Persia here. I'm actually hella excited for this video and I'm not even going to hide it because if you saw on my Instagram a few days ago, and if you haven't, by the way, this is my Instagram, so if you want it, feel free to go and give me a follow. And at the same time, be careful of all the fake accounts that will message you asking for money. It's not me again. I've said that 1,000 times. I will never do that. But as I said on my Instagram, I've planned around 4 to 5 videos. There's a 5th one that I still need to actually plan it in details. And these videos are literally going to paint a clear picture of my approach towards the charts. The extra things I always take in consideration when I'm analyzing or when I'm taking entries. And hopefully there will be a lot of new nuggets that you'll take away from these videos. And by the way, as I said on my Instagram, by planned, I don't mean in my head. I mean literally they've been planned and scripted on paper. And I'm in the process of recording, editing, and posting them. So yes, this is going to be the very first video. The first couple videos are going to be a little bit more on the basic side because we have to get some basic stuff out of the way before we get into some more advanced stuff such as entries. And in today's video, we are going to be speaking about your typical break of structure versus what actually takes place in the market and the idea of mixing supply and demand with market structure. Structure is key. Structure is king. This is something that you have heard a lot of traders have said this, a lot of educators have said this, and I don't necessarily disagree with it, but it's important for us to remember that structure on its own is simply incomplete. Simply because the institutions know how retail traders look and perceive structure, and they simply move the market against it. So enough of the introduction, let's go ahead and jump straight in the video. And the very first thing we are going to be speaking about is the typical retail teaching surrounding break of structure and how to trade it. And if you feel like you know this, feel free to skip to whatever number you see in front of you in the middle of the page right now. But it's always extremely valuable to know and to remind ourselves how majority analyze and trade to know what not to do. So within the very typical and basic teachings in structure in the retail community, you often have these moves that create new points, new waves in the market, and people will consider any move below or above a high or a low as a break of structure. So as soon as they see a wave to the downside, for example, this first wave, retracement, and then the second wave, oftentimes people are getting ready for their entries, and the retail community uses a variety of different things to help them for their entries, such as drawing Fibonacci's and trading based on these golden pockets, using some moving averages and waiting for the crossover or waiting for the market to retrace back after a break of structure to in a way tap off that moving average or this dynamic support and resistance line as we call it, before taking the trade to the downside in this case, or to the upside if it was flipped. But this scenario doesn't happen to work out majority of the times when you're actually analyzing the charts. You've seen a lot of the examples where you have a very clear trend, a very clear structure, and the market does come back and mitigate some of the most key levels within the range, and it goes in that direction, but it never tends to continue. It always ends up reversing, maybe manipulating you out of your trade before going in that direction. And in a lot of the cases, the retail community doesn't take into account the slightly bigger picture. For example, this same break of structure, the quote-unquote break of structure to the downside on a slightly higher time frame can look like this, where you have a trend coming up, but your first 1, 2, 3 wave is technically breaking that internal structure to the downside, but on the scale of things, it hasn't done anything important. It hasn't actually invalidated this entire trend coming up. So can we actually consider this a break of structure? Can we actually consider this a bearish trend? And will we be on the right side of the trade if we decide to trade this to the downside? I'm not too sure about that. And fair enough, some of you might be watching this right now thinking, no, actually, I trade this type of structure breaks and I trade this type of general analysis of structure, and it does work out a lot of the times. And that's why I've written this here. No trade is wrong if you know where to get out. For example, if you're trading this behavior to the downside, you may be lucky and it may give you another leg to the downside just to come back down and maybe mitigate something that's been left open over here. And within that move, you will be able to take advantage of that trade and will close in profit. But that's the exact issue. In the typical retail teachings that accompany structure, they do not exactly tell you where to get out. Oftentimes it's just the fib extension, or it's just the next low, or the next moving average. It's quite vague. You don't know exactly where to get out. That's why a lot of the times it will result in either losses or broken even trades. Another issue with trading this type of retail explanation of structure is that a lot of traders will just trade continuations of any break of structure that they see. So if a trend is continuously breaking structure to the downside, they will continue to sell and sell and sell. And I'm not saying that's wrong. At the end of the day, majority of the times the market is in continuation phase, not in a reversal phase. But the issue is that traders will see these type of trends too late. So there will have already been maybe 2-3 breaks of structure that has already taken place, and now they're trying to take advantage of the next one, not knowing that that can potentially lead to a reversal. Again, looking at this behavior on slightly higher time frames, it could look completely different. For example, an accumulation that has resulted in a reversal and the market being pushed to the upside, and the lowest levels that have already been mitigated. There might have already been elements of manipulation and liquidity capture as well, so there's no need for the market to revisit these lows, but then you'll have some imbalances, some impulsive moves to the upside, and this trend that's coming back down that keeps giving breaks of structures, and the traders will get in at the last point, which is way too late to trade it. In reality, it's just coming back down to mitigate the final levels that haven't been mitigated, only for it to get ready for the next impulse to the upside. And I'm certain you've experienced this. Whether you were trading the highest breaks of structures at the top of the range, or whether you were trading the last ones, for example, over here, thinking that a move like this, this is also coming back down, let me try and sell it. Either way, you've either been manipulated out here, or you've kept these trades open for way too long, the greed has kicked in, and once the reversal came in, it resulted in you either losing that trade or closing at a break even. Again, let me reiterate, it's not wrong if you know where to get out. No trade is wrong if you know where to get out. But that's the issue. People don't get out. People will just keep seeing breaks of structure. They'll get in too late. And by the time the market reverses and comes back up, all of the profit that was actually realized on their account will disappear. And the thing is, a lot of smart money traders, a lot of institutional traders also fall for this trap as well. Maybe they're not trading based on some fib levels. Maybe they're not trading based on moving averages or other things. Maybe they're trading based off unmitigated levels at the top of the range. But again, they keep themselves in the trade for too long. And because the analysis began by a flawed explanation of structure, the entire trade could be questionable, and before they know it, it hits break even or it hits stop loss. Let me ask you this: how many times have you had a perfect structure created on your trade that you're about to take, and a perfect candle that hasn't been mitigated, and you go ahead and take a trade based on that candle, it goes in profit for a few pips, and you're happy, you're on top of the world, you're thinking, yep, I just caught the trade of my career, and before you know it, it reverses on you and hits stop loss. There are explanations for this at the end of the day, so let's go into detail about some of these explanations. There's no better way to put it. Structure on its own is not enough. There are many different ways people approach this and have tried to make sense of it for themselves, but for me, in my own journey of backtesting, I have realized that if one has a good enough understanding of supply and demand and uses it alongside structure, they tend to be able to either avoid getting in losing trades due to, a typical break of structure, or they will get in before a lot of other structure traders do with a more safe entry that's safe from manipulation. That's what I'm going to try and break down in the next couple scenarios for you. So sometimes what people perceive as a break of structure is actually not a break of structure at all and a liquidity capture while tapping into a more relevant supply or demand level. And just for the sake of definition, by supply and demand levels, we can refer to the typical supply and demand understanding being drop-based drop, rally-based rally, rally-based drop, drop-based rally, all of these things. At the end of the day, these are also Wyckoff schematics. So Wyckoff in itself is another explanation of supply and demand, or vice versa, I should say. But generally by supply, I mean a level that sponsored a bearish move, and demand a level that sponsored a bullish move. Let's simplify it like that. So a lot of traders would be seeing scenarios like this, maybe a consolidation or redistribution taking place as the market is creating lower points and a structure point in the middle of the range over there. That's not an internal structure point per se, because you have a high, low, lower high, lower low, lower high, lower low. The internal structure points would be all of these little things that are happening in the middle. And then traders would look at this expecting the market to reverse somewhere around there. So expecting to take trades based on this level in the market and, sell it to the downside based on some unmitigated candles or whatever it may be. And they would be extremely surprised to see the market punch above it and then go in their direction. So as I said, sometimes what you will perceive as a breaker structure is not a breaker structure if it's coming back up to react off of an unmitigated level of supply that's a major level higher than your structure point. In that case, that structure point is simply liquidity. That's all it is. It's simply there to entice traders to get in their trades early, whether they're trading with Fibonacci's, whether they're trading based on supply and demand levels, whatever it may be, and then you'll simply manipulate them all, react off of the important level, and come back down. And once traders see this break of structure, the quote-unquote break of structure happen to the upside, obviously they'll be taking their entries maybe based on a touch of a trend line over here, or again based on the Fibonacci's that they're drawing. And the market plays with your feelings because it will go in your direction temporarily. It will, because it's coming back up to mitigate anything else that's left open over there. And then in the process of doing so, it's enticing more traders to get in, only to reverse and manipulate them out of their trades. And again, a lot of traders will get in again at some equal lows or support levels, or maybe at a lower level that's unmitigated over there because you've seen a break of structure. And again, it'll repeat the same thing. It'll go in your direction a little bit before reversing and taking you out. Only because you haven't been paying attention to some supply levels that have not been mitigated at the top of the range. And it's not just about whether or not it's been mitigated, it's also about where that supply level is being created. The main supply level in this case has been created before the recent leg to the downside. So this being the obviously high, low, lower high. In the process of this creating this lower low, before breaking this low, that supply level was created. That makes it an important one at the end of the day, because that was where supply was introduced to sponsor the price below. So once it comes back for the mitigation, remember what we spoke about in the liquidity video, it needs to manipulate people out of their trades to open room for the institutions to get in their own position. And this isn't just the behavior that you will see on a small range in the market. It can happen on any time frame and at any size. Sometimes these retracements back up, and the breaks of structure that you will see within the range is a lot more than just one little reach above a structure point before the market comes back down. For example, sometimes you could have multiple breaks of structure, quote unquote breaks of structure to the upside, in the process of it mitigating an unmitigated supply or distribution level. And I'm pretty sure you've seen scenarios like this where there has been a distribution at the top of the range sponsoring the price below. It hasn't exactly been mitigated, and as the price has been creating new structure points, it's just been really redistributing and going down, redistributing and going down. On its way back up, a lot of traders would end up trading this on the bullish side once they see the first or the second break of structure, without taking into account that there is an unmitigated distribution at the top. Again, for the third time in this video, I'd like to reiterate, it's not wrong if you know where to get out, but the issue is a lot of traders, retail or quote-unquote institutional traders, would end up getting in with a stop loss that's much bigger than what they initially anticipated. Don't obviously pay attention to the stop loss pips here. We're talking about risk to reward, and therefore, because of that, they wouldn't have a good enough risk to reward for them to want to get out at that level. And the rest of that is hope. They just think to themselves, hopefully you'll break that to the upside as well, because we've gotten a couple breaks of structure to the upside already. And they don't end up paying attention to the general order flow and what's actually taking place. A distribution or a supply level introduced at the top, a couple of structure points in the middle, and the whole purpose of these structure points was to create more liquidity, from trendline liquidity to then manipulate people to the upside over there, to people who are waiting for some equal highs or resistance levels to be tapped off again, whether it be at this structure point or the one above it, or even traders who are trading based on, institutional concepts and trading the unmitigated candles within these structure points here. Now, I have to make myself clear. I'm not saying in scenarios like this, don't trade this to the upside. No, do that. That's absolutely fine. But if you're going to be trading this to the upside, you have to trade based on the lower time frame range. And you have to constantly remind yourself that, hey, This is the higher time frame behavior, the higher time frame structure points coming down, and I'm trading against that. I'm trading lower time frame behavior. So if I manage to somehow get myself in over here, I have to assume that it could potentially react over here. So I need to get out. If it ends up breaking that level and then comes back down for a good retracement and gives you entry opportunities over here, again, you have to look back, ask yourself what's unmitigated, and make sure you are getting out or at least securing some profits and breaking your trades even as it's approaching that level. For you to have a better understanding of the mechanics of what's taking place, again, I've said this, but I'm going to repeat it one more time. There has been supply introduced at the top of the range, and it needs to come back up for the mitigation of that supply. If the intention is to create another leg to the downside, there needs to be sellers that are being manipulated out of their trades in the process of this coming up. So once that mitigation takes place, there have already been enough manipulations, or there have already been enough buy orders. Sell orders manipulated is buy orders. Remember what we spoke about in the liquidity video. And once there's enough buy orders, the institutions can literally balance it out by opening their own sell positions again at the top of the range and pushing the market lower. And a quick point for you to just take note of, sometimes I think to myself, after a very obvious break of structure, wait for some manipulation to happen before getting in your trades. So if I'm seeing a very typical break of structure that any retail trader, anyone with a little knowledge of market structure would be able to spot as well, I wouldn't trade that. I would wait for some type of a manipulation to happen, whether it be equal highs, equal lows, trend lines, whatever, and then I'll get in the trade after that. So the analysis can change slightly, but majority of the times it will stop me from getting in stupid trades. So yeah, I just wanted to quickly show this example as well to highlight the importance of paying attention to the range that you're trading. If you do decide to go against the main trend over here and trade this to the upside, you have to monitor higher time frame and lower time frame together, the relevant higher time frame and lower time frame, not monthly and 1 minute. For example, 15 minutes and 5 minutes, or 5 minutes and 1 minute. And that in itself can get confusing, I know, but with good risk and trade management and a bit of experience, it does become a walk in the park. Not to have 100% accuracy, but to be profitable. Now, speaking of structure and supply and demand, there's another scenario that I have traded a lot, and it's important for you to know as well. Sometimes a typical break of structure or a sign of reversal happens much earlier than what people consider a break of structure to be. How many times have you been waiting on a break of structure to confirm your trades, but once it happens, there's no pullback? You never end up getting in those trades, and now you're confused. Shall I wait for that entry? Shall I not wait for that entry? Shall I put my entry slightly higher? And it just messes up your entire day as a trader. These scenarios do happen a lot as well, and honestly, some of the best trades that I have had comes from paying attention to where the proof of a certain supply or demand is kicking in, which doesn't have to be related to a typical break of structure. So if a lot of people are looking at this type of structure to the downside, obviously that's the high, lower, lower low, and then lower high over here, resulting in a lower low. Sometimes people might consider this the lower high, but people who are even slightly more knowledgeable of structure, they would go ahead and consider this as the lower high, because that's exactly where the lower high is. The highest high formed below the previous high. So in a way, the highest higher low, if that makes sense. So not this one. The other one that's higher than that. And again, you're not going to see this part of it extremely clean on the charts because I've oversimplified it a bit. Obviously, this entire thing on the charts can just look like a couple waves and the market coming back down again. So it's not as easy to just go ahead and put this as the major structure point. But anyway, a lot of traders do consider that higher point as the major point to be waiting for a break of structure based on this one over here, the blue line. And oftentimes there's an entire cycle that takes place over here where there has been more liquidity created. There's been manipulations, there's been mitigations of the highest points over there, and before it breaks the lows, before it creates the next lower low, it ends up introducing a new supply level, again in a form of a drop-based drop or some distribution or redistribution, whatever. It's all the same thing, but it ends up introducing a new level of supply, which is above the lows. That's important, okay? And the scenario that takes place a lot is the market can come and tap a level of demand or whatever. There's another level that maybe needed to be mitigated, or maybe there was a manipulation, whatever, an important level that needed to be tapped off at the bottom. And as it comes back up, it invalidates this supply level, But this is not what people are considering a break of structure. They're waiting for this level as a BOS. And at this point, they are considering this another potential lower high. And then the market comes back down, comes to the lowest point again, mitigates anything that needs to be mitigated over there, creates some type of an accumulation or some other level of demand, and then starts to go up. By the time it breaks this structure point that a lot of traders are waiting on, it's already too late because everything down there has already been mitigated. So it doesn't even necessarily needs to come back down to mitigate anything at that point. It may come back down later, so it just reaccumulates and off it goes. You must have seen scenarios like this. You must have been a victim of this as well, where you're waiting for a breaker structure to happen, but once it does, it doesn't pull back to give you those entries. With a little bit better knowledge and understanding of supply and demand, you'll understand that this was the major place that needed to be invalidated, since everything above there was already mitigated, since we already had a lot of manipulations that took place up there. So as soon as this level is invalidated and the market doesn't respect it, if you're wondering what I mean by invalidation, is what I've drawn, like reaching above it, right? Not respecting it. Then more or less you're clear for your entries. So as this is coming back down, we'll end up getting in somewhere at the bottom over here. And as it's going up, you'll just enjoy the impulses that are continuing rather than having to wait for another pullback and it never happens and now you're stressed and annoyed and so on and so forth. So this in a way is an example of where you get a proof of a certain level. So like a proof of a demand level or a proof of reversal before your typical break of structure. Now I must be honest with you, there are countless examples that can take place on the charts. The previous few examples that we spoke about is just to expand your understanding of what is possible. Just remember, every supply level is in battle with a demand and vice versa. So any supply level, for example, this one is in battle with a demand level, for example, at the bottom of the range over here, and whichever one wins, you're able to trade in that direction within your relevant range. So there may, for example, be some level of distribution at the top over here that again hasn't been mitigated. Wow, that looks like a very bad distribution. But anyway, so the relevant range that you should be trading would obviously be up to that distribution, not above it. But anyway, talking of different scenarios that can happen, it's borderline impossible to be drawing every single one of them out because every scenario has its own uniqueness. So more than being worried about highs and lows and trying to remember this as a pattern, understand the behavior, understand the mechanics, for God's sake. I think I've said this enough in all the previous videos. Now let's start to talk a little bit about fake breaks of structure that happen, where the market breaks structure in multiple different directions before going in a given direction, and try to understand again the mechanics behind that and why that takes place. Many times in trading in the markets, you will see a break of structure that looks amazing. But after that, the market reverses completely, breaking structure in the other direction. And sometimes it even comes back and breaks structure in the opposite direction again. At times like this, instead of looking from a structural perspective, analyze based on liquidity. That's it. And understand that most likely the intention from an institutional standpoint is to wipe out traders, is to create more liquidity and to manipulate more people. In this example, after the first break of structure, many traders, regardless of the style of trading, will be looking for sells within the range of this high to this low. They're seeing a break of structure, so whether it be trend lines, Fibonacci's, moving averages, or even trading based on unmitigated levels, this will be the leg that they'll focus on. Once it goes above that high and breaks structure again, a lot of traders have now been manipulated out of their positions and they will see another break of structure to the upside and will potentially even focus on buys this time. Obviously, the minority of traders will be able to understand this behavior and will end up trading based on these levels and trade these to the downside over here. But at this stage, majority of the traders are looking to buy it, and yet again, they will be manipulated out. In my experience, if you pay close attention to supply and demand and ask yourself, what is the significance of that specific break of structure? That was a very important phrase I just said. what is the significance of that specific break of structure, then it will stop you from taking bad trades. For example, let's have a look at what's actually taken place over here. Maybe we're coming down from a mitigation of a previous level of supply and creating a leg to the downside. As this is retracing to come back up and mitigate whatever else that was left open over there, it's creating another minor trend, which is introducing a lot of traders on the buy side over here, again, only for them to be manipulated out again. And then this first move to the downside that has broken this internal liquidity would be kind of a decisive factor for some people to get in the sell positions. They may be able to snipe it at the top over here and trade this leg to the downside, but oftentimes they will keep the trade open thinking it's going to go lower and lower and lower, and by the time it comes back up, they're manipulated out. But what's the significance of this second break of structure? So what is actually the significance of this impulse to the downside? We are looking at a retracement. So from this low to this high, we've broken the internal structure to the downside over there. Fair enough. The market retraces and then breaks this structure point to the downside, or this one, for example, at the same time to the downside. But what has it actually done? It hasn't actually in itself extended the whole range coming lower. It hasn't reached below this lower low. Obviously, it might have been a trend coming back up, so that could be the high, low, lower high. It hasn't created a lower low yet. It's just coming back down over here. And in a lot of the scenarios, there will be some accumulation or some level of demand that's not mitigated at the bottom over there. So by the time it mitigates it, it results in an impulsive move to the upside, coming back up, breaking structure to the opposite direction again. But this isn't exactly a structure break, is it? It's just reaching above where a lot of people would be putting their stops. So in the process of mitigating whatever else that was left open over there to sponsor this push up or this retracement back up, it's going to manipulate a lot of early sellers and again mitigate whatever else that's left open up there. And then once this gets extended to the downside, oftentimes after this leg, you will be given good entry opportunities, but sometimes it might not even retrace back. So it may not come to the top of the range. It might literally react off of some drop-based drops in the middle of the range. So it makes sense to take some trades lower. I would still argue and say it's better to have our stop losses above or manage risk in a way that you have two positions with entries here and stops here and a secondary position with the same entries and a different stop loss and divide your risk between the two. Because it's not about the absolute best risk to rewards you can take out of the market. It's about good enough risk to rewards, 1 to 5s and 1 to 10s and above, that you can just catch consistently, that will little by little grow your trading account and build that wealth. So remember, in scenarios like this where you're seeing fake breaks of structure in different directions, think liquidity and think significance of a break of structure. In the next slide, I'm going to give you a couple advice that was absolutely game changing for me, so hopefully that will definitely help you. But before we move on to the next and the final slide, how does one even know if a fake break of structure is likely to take place? There's a couple different points or 3 points that I have written down here that hopefully will help you. Number one, pay attention to major areas of supply and demand that are not mitigated. So if you have breaks of structure taking place, but there are very clear levels at the top of the previous range that are unmitigated, there is a chance, a good chance of that fake break of structure taking place and the market coming back up and mitigating that level. And obviously in the process of doing so, creating more fake structure points to manipulate more traders out of their trades. The second thing you can do is zoom out and see 1 to 3 higher time frames and see if the lower time frame behavior is setting up for something that makes more sense on the higher time frames. So this is the slightly higher time frame picture. On the lower time frames, this is going to look even crazier. But when you're looking at the markets and you're like, I have no idea what it's doing, I really don't know which direction it's headed towards, then it may just be setting up for something bigger on the higher time frame. So sometimes pause and zoom out. Go 1 to 3 time frames up and analyze again. Don't be so hungry to take a trade. Patience and a no trade scenario is sometimes the best option. And finally, instead of trying to perfect your approach towards technical analysis, perfect your approach to the only thing you can control: risk and account management. And by the way, this is a brilliant example I can show very quickly of the drawing that I just had, where obviously we're creating a high, a low, a lower high, and then this is the lower low. But in the leg that was creating this lower low, we had another structure point created over there. So another high, low, lower high, lower low. A lot of traders probably looking to take some trades in the middle of this range over here, being manipulated out. So maybe a break of structure to the upside if you would consider this a BOS, and then only for this to reverse and come back down again. Talking of significance of a breaker structure, obviously from a liquidity standpoint, this is very obvious what was taking place. It's just creating liquidity, manipulating that and coming back down. But talking about the significance of a break of structure, after we created this low, lower high and lower low, it didn't actually in itself extend this low. It didn't extend the whole range. I hope this is starting to make a little bit more sense now. But let's go ahead and move on to the very final slide and wrap up this video. I mentioned this in the liquidity video and probably many times throughout this video. For the market to be able to move in a certain direction, there needs to be people on the other side being manipulated out of their trades. So from now on, in your structure analysis, always pay attention to if there have been enough traders that have already been manipulated out of their trades, enough retail traders that have been manipulated out of their trades. And honestly, I'm using the term retail traders a lot. I'm not referring to the traders who are just trading extremely basic retail concepts, but any trader or firm who trades based on extremely obvious levels, strategies, who in the long run will be manipulated. Now pay attention to this next thing I'm going to say, because this will be very, very, very important. If the market has gone some time without doing a madness and manipulating people out of their trades, be patient, because it's going to happen. Pay attention to trendline liquidity just as much as you pay attention to equal highs, equal lows, and everything else. And in scenarios like this, where for some time the market has just been too perfect, it just doesn't look like it's done any madness, any manipulations, don't trade. That's the best trade, okay? Or don't trade at least the most obvious behaviors that you're going to be seeing. And to be fair, who am I to even give advice to people? Do whatever you want to do, but at least know where to get out. At least know where you should exactly target to stop yourself from being a victim of these random reversals that take place in the market. And finally, to strengthen your understanding of these things, pick a range on higher time frame, zoom into it on lower time frames, and analyze it first from a purely structural perspective, then only from a liquidity and supply and demand perspective. And backtest for yourself how many scenarios for trades have played out based on a typical breaker structure versus based on supply and demand and liquidity analysis. Which one ended up giving you better risk to reward, better entries, smaller stop losses? Backtest this for yourself. Remember what we spoke about in the previous video. Analytical mind and critical thinking is necessary for this industry. Now, to say a final few words before this video finishes, as I mentioned, there's going to be another 3 or 4 more videos that I have planned already, which by the end of them, you should have a good understanding of taking the correct entries based on correct order flow and based on liquidity, and how to avoid being liquidity yourself. And I say this all the time, but just to finish it off, I will say it one more time. We don't need 100% accuracy. So don't aim for perfection, aim for progress. So let's elevate and let's catch some pips.